Something I've learned about private company valuations is that they only get tested when someone actually has to write a check. SpaceX just became the most valuable private company in America, $400 billion. That's more than Boeing and Lockheed Martin combined, more than Disney, more than Pfizer. And here's the fascinating part. Nobody's buying shares on the open market. This valuation comes from internal tender offers where employees sell stock to each other and to a handful of approved investors at prices the company essentially controls. In my 94 years, I've learned that the real test of value isn't what someone says something is worth. It's what happens when you actually have to sell it to someone who has choices. So let's talk about whether SpaceX is genuinely worth $400 billion, or whether we're watching another private market bubble inflate before our eyes. Here's the situation in one sentence. SpaceX has gone from a $210 billion valuation in mid-2024 to $350 billion by December to roughly $400 billion today, nearly doubling in 18 months, all while remaining private. Think of it like this. Imagine you own a farm. Every 6 months, you tell your farm hands they can sell some of their ownership shares to each other or to your wealthy friends. You set the price. You approve the buyers. You control who sees the financial statements. Each time you do this, you raise the price. $100 per share, then $185, now $212. And because there's no public market, no way for anyone to sell freely, people accept your price or they don't sell. That's basically what's happening here. SpaceX conducts tender offers, controlled internal stock sales that set the company's valuation. No public scrutiny, no quarterly earnings calls, no SEC filings. Just Elon Musk and his team deciding what the company is worth. Now let me be clear, SpaceX is a real business. They launch more rockets than anyone on Earth. Starlink is revolutionizing satellite internet. The technology works. The revenue is real. But $400 billion, that's what we need to examine. Because here's what makes this moment particularly telling. At $400 billion, SpaceX is valued at roughly 25 times its expected 2025 revenue of $15.5 billion. For context, Boeing, a century-old aerospace giant with $78 billion in annual revenue, has a market cap around $105 billion, or about 1.3 times revenue. Lockheed Martin, with $71 billion in revenue, trades around $133 billion, or about 1.9 times revenue. SpaceX is getting a valuation multiple 12 times higher than established aerospace companies. Is that justified by the fundamentals? Or are we watching speculation drive prices in a market with almost no liquidity? Let's start with the numbers, because in my business, numbers matter. SpaceX is projected to generate $15.5 billion in revenue in 2025. Of that, roughly $11.8 billion comes from Starlink, the satellite internet business. Another $3.5 billion from launch services, sending rockets to space for NASA, the Pentagon, and commercial customers. The rest from government contracts and other services. The Starlink numbers are genuinely impressive. They've grown from zero revenue in 2020 to $11.8 billion projected for 2025. They have 8.5 million subscribers as of September. They're adding customers at about 70 to 80% annual growth. Launch services are equally impressive. SpaceX launched 138 times in 2024, accounting for nearly half of all global orbital launches. Their Falcon 9 rocket has a 99.4% success rate. They've essentially monopolized the commercial launch market, with competitors struggling to match their pace and pricing. So the business is real. The growth is real. The question is whether it's worth $400 billion. Here's where it gets interesting. Multiple research firms have tried to model SpaceX's future value. Their projections range wildly. Conservative estimates put 2028 valuation around $587 billion. Base case scenarios suggest $1.3 trillion. Bull case projections go as high as $2.7 trillion. Now, I've been valuing companies for 7 decades. When analyst projections range from $500 billion to nearly $3 trillion, that tells you something important. Nobody actually knows what this company is worth. They're guessing. And when everyone's guessing, you need to be very careful about the price you pay. Let me give you some context on profitability. Starlink, the crown jewel driving most of SpaceX's value, has shown improving margins, but remains in growth investment mode. Financial filings from their EU subsidiary showed $72 million in net profit for 2024 operations there, though global profitability is harder to assess given SpaceX's private status. Some analysts project overall free cash flow reaching $2 billion in 2025. The key point, margins are still thin. Even optimistic estimates put profit margins well under 10% as they continue investing heavily in satellite deployment and network expansion. Now let's be generous and assume SpaceX generates $2 billion in total operating profit in 2025. That's an optimistic projection. At $400 billion valuation, you're paying 200 times current earnings. That's a multiple that assumes extraordinary growth and profitability expansion for many years. For comparison, Amazon, which also lost money for years building infrastructure, trades at about 40 times earnings today. Tesla trades around 70 times earnings. SpaceX is getting valued at multiples that assume not just success, but spectacular, unprecedented success for decades. Let me explain something about SpaceX's business model that most people miss. They have 2 fundamentally different businesses under one roof. One is capital intensive and competitive. The other is a potential monopoly with network effects. Understanding the difference matters enormously for valuation. The launch business, sending rockets to space, is brilliant execution, but commoditizing fast. SpaceX charges about $60 to $70 million per Falcon 9 launch. They have the best technology and the lowest costs, no question. But here's the thing about rockets. The barriers to entry are falling. Blue Origin just successfully launched its New Glenn rocket. China is investing billions in reusable rockets. India's space program is expanding. The technology SpaceX pioneered, reusable first stages, is being copied. In 10 years, SpaceX might still be the market leader in launches, but will they command premium pricing? Will margins hold? Or will launch services become like airlines, essential infrastructure that destroys capital? I've watched this pattern for 70 years. Revolutionary technology becomes normal technology, becomes commodity technology. The Wright brothers flew at Kitty Hawk in 1903. By 1930, there were hundreds of airline companies. By 1970, most were bankrupt. The technology transformed the world. The business model destroyed wealth. Now, Starlink is different, very different. This is where the real value might be. Starlink is building a global satellite internet network with genuine competitive advantages, network effects, economies of scale, first mover advantage. The more satellites they deploy, the better the service, the more customers they attract, the more revenue funds more satellites. It's a flywheel that could genuinely create a moat, if they execute well. Here's the math that matters. Starlink has 8.5 million subscribers. They're growing about 75% annually. Let's say they reach 20 million subscribers by 2027. Aggressive, but possible. At an average revenue per user of $1,200 per year, combining residential, business, government, maritime, aviation customers, that's $24 billion in annual revenue. If they achieve 25% profit margins at scale, that's $6 billion in annual profit. Now apply a multiple. A communications infrastructure business with strong growth might deserve 20 times earnings. That values Starlink alone at $120 billion. Add the launch business. Let's be generous and say it's worth $50 billion, given their technological lead and government contracts. Add Starship development potential, another $30 billion for the option value on Mars colonization and heavy lift capability. That gets you to $200 billion. Maybe $250 billion if you're optimistic about everything working perfectly. But $400 billion? That's pricing in not just success, but breakthrough, transformational, change the world success, and doing it in a market where you have no ability to sell if you change your mind. Here's what concerns me most. The valuation has doubled in 18 months. Did the business fundamentals double? Did revenue double? Did profits double? No. Revenue grew maybe 40%. Profits barely exist. What doubled was the story, the narrative, the hope, the fear of missing out. I've seen this movie before. In 1999, Cisco was worth $500 billion. Brilliant company, revolutionary technology, growing fast. The internet was obviously transforming everything. Cisco's stock fell 86% over the next 2 years. The internet did transform everything. Cisco's technology worked, but the stock price had run too far ahead of the business reality. The technology was real. The valuation was fantasy. Here's what this valuation means practically. If you're a SpaceX employee with stock options, you're probably feeling pretty good right now. Your equity statement says you're a millionaire, maybe a multimillionaire. But here's the question you need to ask. Can you actually get that money out? SpaceX conducts tender offers maybe twice a year. They limit how much you can sell, typically 10 to 25% of your vested shares. The company approves the buyers. The company sets the price. And the company can cancel or delay tenders anytime they want. So yes, your shares are worth $212 each, but only if you can sell them, only if there's a buyer, only if the company allows it, only if the valuation holds when you actually go to cash out. That's very different from owning Apple stock. If I want to sell Apple tomorrow, I can sell millions of shares before lunch at market price. There's liquidity, there's price discovery, there's reality. With SpaceX, you have a number on a piece of paper that depends entirely on whether Elon Musk decides to let you sell and whether investors still believe the story when you finally can. If you're an investor who bought SpaceX shares on the secondary market at these valuations, you've made a bet with very limited exit options. You can't just wake up one day and sell. You need another tender offer. You need SpaceX's approval. You need someone willing to pay even more than you did. That works great when everyone believes valuations only go up. It works terribly when sentiment shifts. Here's another angle. SpaceX raised $5 billion in mid-2025. As part of that deal, they agreed to invest $2 billion in Elon's other company, xAI. Think about that for a moment. They raised capital from investors at a $400 billion valuation, then immediately invested $2 billion in a separate Musk company. Is that capital allocation in the best interest of SpaceX shareholders? Or is it using one company to prop up another company in Elon's empire? I'm not saying it's wrong. I'm saying it's the kind of thing that happens in private companies without public oversight. Conflicts of interest that would raise questions in a public company can happen quietly behind closed doors. And here's what nobody's talking about. SpaceX is deeply dependent on government contracts and regulatory approval. NASA provides over $1 billion in annual contracts. The Pentagon is increasingly relying on Starlink for military communications. The FAA approves every launch. What happens if political winds shift? What happens if a new administration decides to diversify its space providers? What happens if regulators get more cautious after an accident? When you're valuing a company at $400 billion, you're assuming everything goes right for decades. No major regulatory setbacks, no competitor breakthroughs, no technology shifts, no political complications, no accidents that ground the fleet. That's a lot of assumptions to get right. And in my experience, when you need everything to go right, something usually goes wrong. If you're trying to value SpaceX using traditional methods, you run into immediate problems. Take comparable companies. Boeing's market cap is $105 billion on $78 billion in revenue. Lockheed Martin is $133 billion on $71 billion in revenue. Both are profitable, established businesses with decades of contracts. SpaceX is being valued at $400 billion on $15.5 billion in revenue. That's a revenue multiple of 25 times compared to Boeing's 1.3 times and Lockheed's 1.9 times. Why the massive premium? The story goes, Starlink is a growth business, not a legacy aerospace business, so it deserves tech company multiples, not defense contractor multiples. Fair enough. Let's use tech comparisons. Netflix is valued at about 6 times revenue. Meta, Facebook, trades around 9 times revenue. Even high-growth cloud companies rarely exceed 15 times revenue. SpaceX is getting 25 times revenue. That's pricing in growth and margins that would make it one of the most successful business expansions in history. Here's another way to think about it. At $400 billion, SpaceX is worth more than the entire U.S. space industry's annual revenue combined. They're being valued at more than the whole market they operate in generates in a year. That can be justified if you believe Starlink will expand the total addressable market dramatically. If satellite internet becomes ubiquitous for mobile devices, aviation, maritime, remote areas, developing countries, maybe the market grows from $15 billion to $100 billion. But even then, SpaceX won't capture 100% of that market. Competition exists. Amazon's Project Kuiper is deploying. OneWeb is operational. China has multiple programs. The window for monopoly is closing. Let me be frank about something. I cannot tell you if SpaceX will succeed or fail. Elon Musk has proven skeptics wrong repeatedly. Tesla was supposed to fail. It didn't. SpaceX was supposed to fail. It didn't. Starlink was supposed to fail. It didn't. Maybe this time is genuinely different. Maybe SpaceX really is building something so valuable that $400 billion looks cheap in hindsight. But I can tell you this with certainty. At these valuations, you need everything to go spectacularly right. You need Starlink to dominate globally. You need Starship to work perfectly. You need no major regulatory issues. You need competitors to fail. You need a decade of flawless execution. And you're making that bet in a market where you cannot easily sell if circumstances change. That's not investing. That's speculation on perfection. This isn't just about one company's valuation. This is about what happens when private market valuations lose touch with reality. When SpaceX is valued at $400 billion based on controlled internal trades with no public market test, that sets a precedent. Other companies look at that and think, why shouldn't we be valued that way? You're already seeing it. OpenAI is reportedly discussing a $300 billion valuation. Anthropic raised money at massive valuations. Stripe, Epic Games, Databricks, all private companies with enormous valuations based on limited liquidity events and optimistic projections. This creates a dangerous dynamic. Employees see paper wealth and make life decisions based on it, buying houses, planning retirements, turning down other opportunities. Investors chase allocations in these companies because they have FOMO about missing the next Google. But unlike public markets, there's no continuous price discovery. There's no daily reality check. Valuations can stay inflated for years because there's no mechanism to test them. Then what happens? One of two things. Either the company goes public and the market immediately reprices it, usually down, or it stays private, and when employees finally can sell, they discover the liquidity isn't really there at the valuations they expected. In 2000, we had the same dynamic with late-stage pre-IPO companies. Valuations rose and rose based on private funding rounds. Then companies went public, and investors discovered the public market wasn't willing to pay those prices. WeWork was the poster child, valued at $47 billion privately in 2019. Tried to go public. The public market took one look at the financials and said, "Are you serious?" Valuation collapsed to under $10 billion. Employees who thought they were rich discovered their equity was worth a fraction of what they'd been told. Now, SpaceX is a much better business than WeWork, not even close. But the dynamic is similar. Private market optimism disconnected from fundamental business value. Here's what really concerns me. When private companies can raise money at inflated valuations, it misallocates capital on a massive scale. Money that could fund genuinely undervalued businesses or productive uses gets locked up chasing growth at any price. And when these valuations eventually reset, which they always do, the losses fall hardest on employees and later stage investors who bought at the peak. The early investors and founders who sold at inflated prices in tender offers walk away fine. The people who believe the story at the top get hurt. That's not capitalism working efficiently. That's a bubble transferring wealth from optimists to early movers. Let me tell you about a conversation I had in 1999. A young tech entrepreneur visited me in Omaha. Smart kid, genuinely brilliant. He was starting a company that was going to revolutionize e-commerce. His investors had just valued his company at $200 million. He'd raised 3 rounds in 18 months, each at higher valuations. No revenue yet, but the story was compelling. He wanted to know if Berkshire would invest. I asked him a simple question. How do you know your company is worth $200 million? He said, because that's what investors just paid. I said, but how many shares actually traded at that price? He said, well, we sold 10% of the company for $20 million, so that values us at $200 million. I asked, if you tried to sell the whole company tomorrow, could you get $200 million? He paused. Probably not, but we're not selling the whole company. That's the thing about private market valuations. They're based on tiny transactions that value tiny slices of companies. then everyone pretends those valuations apply to the entire enterprise. That entrepreneur's company went bankrupt in 2002. The technology was fine, the market opportunity was real, but the valuation was based on hope and momentum, not sustainable business fundamentals. I learned something important from watching hundreds of these stories play out over decades. The price you pay determines your returns, not the quality of the business. SpaceX might be an incredible business. It probably is. But if you pay too much, even a great business produces poor returns. And right now, at $400 billion, with limited liquidity and limited financial transparency, you're paying a premium price for a company where you can't easily get out if you're wrong. If you're still reading, you want to know, what should I actually do with this information? If you're a SpaceX employee with stock options, be smart about diversification. When tender offers come up, consider selling some shares, even though you believe in the company. You don't need to sell everything, but getting some liquidity reduces your risk. Your financial future shouldn't depend entirely on one private company's valuation holding up, especially a company where you can only sell occasionally at prices the company controls. Take some chips off the table, pay off debt, build a cushion. Don't let paper wealth make you feel richer than you actually are. If you're an investor who bought shares on secondary markets, understand what you own. You've made a bet on Elon Musk's execution, on Starlink's growth trajectory, on Starship's success, and on your ability to eventually find an exit at higher prices. That might work. Elon has proven doubters wrong many times. But you're paying 25 times revenue for a company that barely turns a profit. If growth slows, if competition intensifies, if anything goes wrong, you're stuck holding shares you cannot easily sell. Be honest with yourself. This is a speculative bet, not a conservative investment. Size your position accordingly. Don't bet money you can't afford to lose completely. If you're a young investor watching this from the outside, learn the lesson here. The best investments aren't always the most exciting stories. They're businesses you can buy at reasonable prices relative to what they'll likely earn. SpaceX might make some people rich. It might also disappoint a lot of people who paid peak prices for peak optimism. You don't need to chase every hot opportunity. There are always businesses trading at reasonable valuations if you're patient and disciplined. If you're just trying to understand what's happening in markets, pay attention to private market dynamics. When companies stay private longer, raising money at ever higher valuations without public scrutiny, bubbles can inflate beyond what public markets would tolerate. The eventual reckoning might come from an IPO that reprices expectations, or from companies that stay private until the story falls apart. But it's coming. It always does. Here's what to watch for. Near term, next 12 months, SpaceX will likely continue raising valuations in tender offers. Momentum is strong. Starlink is growing. Media coverage is positive. The story holds. Midterm, 2026 to 2027. Two possibilities. Either SpaceX begins seriously discussing a Starlink IPO. Elon has suggested this might happen when revenue growth stabilizes, or they conduct another massive funding round at even higher valuations. An IPO would be the reality check. Public markets would scrutinize financials, demand transparency, apply real comparable valuations. That's when we'd find out what institutional investors are actually willing to pay. Long term, 2028 plus. Three scenarios. Scenario A, 20% probability. Everything works. Starlink reaches 30 million subscribers. Starship enables cheap Mars missions and revolutionizes launch. SpaceX becomes a $1 trillion company, and current valuations look cheap. Scenario B, 60% probability. Mixed results. Starlink grows solidly but faces competition. Launch business remains strong but commoditizes. SpaceX is a very successful company worth $200 to $300 billion. Current investors make modest returns or break even. Scenario C, 20% probability. Major setback. Regulatory issues ground Starship. Competitor breakthroughs erode Starlink's advantage. Growth slows. Valuation resets to $150 to $200 billion. Late-stage investors take significant losses. I can't tell you which scenario we'll get, but I can tell you that paying $400 billion today assumes scenario A, and betting on best-case scenarios rarely works out well. Let me be clear about something. I'm not rooting against SpaceX. I admire what they've built. Reusable rockets are genuinely revolutionary. Starlink is solving real problems for real people. The engineering is spectacular. But admiring a business and paying any price for it are two different things. The truth about SpaceX's valuation is straightforward. It's a real business with real revenue and real growth. $400 billion is an extraordinary valuation requiring extraordinary success. That valuation is determined in a private market with limited liquidity and limited transparency. You're paying 25 times revenue for a company that barely turns a profit. When things eventually don't go perfectly, and they never go perfectly, that valuation will adjust. The quality you need most when looking at valuations like this isn't optimism or pessimism. It's realism. The ability to separate what a business is actually worth from what people are currently willing to pay for tiny slices of it in controlled transactions. In the short term, SpaceX's valuation might keep rising. Momentum and enthusiasm can push private market prices higher for years. People who bought at $300 billion might sell at $500 billion and feel like geniuses. But in the long term, valuations converge to what businesses actually earned, not what people hope they'll earn, what they actually earn. Elon Musk is a remarkable entrepreneur, maybe the most remarkable of this generation. He's built multiple multi-billion-dollar businesses that skeptics said were impossible. But that doesn't mean every price is a good price. Tesla at $50 billion was a great buy. Tesla at $1.2 trillion was not. The company didn't change. The price changed. Right now, SpaceX is being priced for absolute perfection. And in my 94 years, I've learned that perfection is the rarest thing in business. Setbacks happen. Competition emerges. Technology evolves. Regulations tighten. Accidents occur. Plans don't work out. When you pay for perfection and get anything less, returns suffer. When you pay for perfection and can't easily sell, losses can be permanent. The market might take years to figure this out. Price discovery doesn't work quickly in private markets, but eventually reality wins. And when it does, the investors who paid $400 billion for a $200 billion business will learn an expensive lesson that I learned cheaply by watching others. Price is what you pay, value is what you get. Right now, people are paying a very high price for a business whose value, while significant, probably doesn't justify it. That's the real story here. Not whether SpaceX succeeds, I hope it does, but whether success at any price makes sense. And the answer, from everything I've learned over 7 decades, is no. Be careful out there. Don't confuse a great company with a great investment. Don't confuse hope with analysis. And most importantly, don't confuse prices set in controlled private transactions with actual market value. The market will sort this out eventually. It always does, and that's worth remembering.